Hello, hello, hello. Welcome to topic 9, lesson 6. Okay, now we look at the characteristics of state-owned profit companies. Okay, profit companies, which means what? They would like to make a profit just like any other company. All public enterprises are owned by the state, also known as the government, and managed by national, provincial, or local government. The form of the public sector, they form the public sector of the economy. The name should end with the abbreviation SOC Limited, SOC, State-Owned Company. State can create those products and render those services that the government believes to be an economic or political importance to the country. So basically, they mainstream it so that everybody receives it, not only the people that can afford these services. Services such as electricity would be unaffordable to some citizens if they were managed by private companies, which aim to make a profit. Government uses money paid in income tax and VAT to set up and manage these businesses. The local government undertakings, such as refuse removal, which are usually funded by local taxes payable as rates and taxes. So the people that take away your refuse once a week is part of a government organization, meaning a government-owned business. An example here is Eskom, which gives us electricity, and then the SABC, which provides channels SABC 1, 2, 3, and then ETV. Okay, now the advantages of state-owned companies. It is essential services which are provided. Everyone shares in the profit from the public ownership. Wasteful duplication of services is eliminated, which means literally only the government provides refuse removal. Other companies that do this at a cost, which means you don't need to pay for, or you don't need to do it because the government already does it. Planning can be coordinated through central control, meaning the Minister of Public Services, for example, can give all the information through to all the other government institutes and they can follow it once off. Now we look at the disadvantages. Inefficiency results due to size of the organization. Sometimes the organization is too big and not everybody gets the right information. The lack of incentive for employees to perform if they are not given a share in the profit or other motivators such as productivity bonuses. Okay, so these employees feel that they do not get motivated because money cannot just simply go to them for bonuses, etc. So in most cases, what the company then does is they give a share of the business to the employees so that they can get a little bit of profit sharing. Losses must be made by the taxpayer. So if they do not make enough money, let's say in the case of Eskom, what do? They put up the rates and taxes for electricity, and therefore we pay more but get less. Now, the political interference can occur. Remember, this has to do with the government, and government is in most cases ruled by the ruling party. State-owned companies interfere with the free market forces. Okay, now this means that not everybody can step in. We cannot have another company that provides electricity because Eskom is already there. So there is no free market force. They are there, and that's that. There may be difficulties in finding someone to deal with complaints, although this factor is also applicable to any large organization. Okay, I am sure somewhere in your life somebody has complained about the municipality, for example. It goes to deaf ears. Nobody can help you. Nobody even knows how to help you. I hope you understand this one. Now, I would please like you to do activity 6 on page 121. Send me a personal message if you don't understand something so that I can help you. Remember, I really do want to help you. And remember, there's no such thing as a stupid question.